Okay, welcome back to my Vanguard portfolio update now, where we have a look at everything inside my stocks and shares ISA and my self-invested personal pension. But just before we log on to my account on the laptop here, let's have a quick review of what's been going on in the stock markets here, both in the UK and over in the States. As usual, it's been a pretty packed month. So starting with things closer to home, let's have a look at our dear old friend, the FTSE 100, and just have a look at the performance here over the last month. And I'll whip this up on screen for you now. As you can see, down 2.5%-ish as I film this video. No doubt as I upload this, things will always change, but to be fair, nothing much happens too much very quickly, at least with this index. Indeed, the hot topic at the moment still very much are those interest rates and high inflation here in the UK. Now, I did a video recently talking about the interest rate rise, which just happened by the Bank of England, how that's going to affect many people with mortgages. But I think one of the key things to remember with interest rates is this also affects businesses too, and then does reflect itself into the stock market here in the UK. You have to remember that lots of businesses had lots and lots of debt on their balance sheet, and over the past few years, certainly through the post-COVID era, they've had very, very low interest rates, so been able to keep their borrowing costs very, very low. Now, the moment they have to refinance all of that debt, which could be in the millions, and for some companies, the billions of pounds, just means every single month they're paying a lot more into that debt to service that debt, just like you would be on a mortgage. They don't get any bigger home, but unfortunately their monthly payments are going to go up. And this really just leaves them with two options. Either they can suck that cost up and reduce their profits, or pass that down to you as a consumer. But I guess either way, you're going to still feel some sort of pain, either as an investor, because your investments are probably going to go down as those profits get hit, or as a consumer, when you're going to see those higher prices down at the supermarket or wherever you buy pretty much anything in the UK at the moment. Outside of that, not a huge amount happening here in the UK, really because the buzzword at the moment is all around AI. And pretty much on the FTSE 100, we don't have anything very much exciting to talk about AI at all. So let's head over to the States and see how some of the biggest markets in the world are doing at the moment. So I'll just throw the S&P 500 chart up on screen now. As you can see, it's having an absolute tear this year so far. But just in the last month, as you can see, it's up 3.4%. As usual, things will probably change by the time I post the video, but this is what we're looking at right now. Now, as I said, AI and all things technology are certainly still hotting up at the moment, and valuations are very frothy, at least for some stocks. Now, last month, I think you'll agree, Nvidia was the hot stock that everyone was talking about. Of course, AI is still very much on everyone's lips. But this month, I think the tides have turned a little bit, and now we're back to the good old hype stock of Tesla. Now, it's gone up 13 times in a row, and it's just been broken, unfortunately. It's a 13-day winning streak, going up over 40% during those trading days. Pretty crazy seeing that day after day. But now it's going on the way back. Who knows where it's going to end up, but a pretty crazy start to the year compared to everything it had to go through last year. Now, just staying on the topic of kind of big companies and those big tech players leading the way, this is quite interesting that I've been keeping a track of over the past few weeks. If you have a look on the screen now, you can see that the market's been driven by just a few very, very big names. Now, just check this out. This only went up to the end of May, but just 5 stocks alone accounted for 56% worth of the gains in the S&P 500. When you compare that against the index itself, the market only went up 8.9%. I say only, but that's a pretty damn good performance anyway for the S&P 500 so far, going through just over half of the year. But very, very interesting how so many of the gains at the moment we're seeing from just a few of those really, really big tech stocks, which to be fair, did get hit really, really hard in the year gone by. And then one more thing I'll just show you along these lines is just showing how much of the market cap, how much of the weight of the entire S&P 500 these big caps make up. Now, as you can see on this chart, historically, they haven't made up as much as they have before, but they are getting up to now nearly a quarter of the entire index. That's 5 companies right at the top there making up that entire quarter of the index, which means when they move, they can move the entire index. Now, this goes on to my next topic, which I was going to touch on just briefly. Is it a good time to invest right now? Well, my opinion will always be yes, but the caveat will always remain A, that you're going to be a long-term investor as an index fund investor, B, that you're going to buy regularly, and C, I guess going back to that long-term nature, that you are going to be in this for a very, very long time. We've got no idea if this is going to be the top for a while, if this is now just a fake bull rally and we're now going to be heading all the way down. We just don't know the future. And the problem is the moment we try and start trying to time the market and think, I better just hold off or I better not do anything, is when we kind of get ourselves in trouble. Now, as you should know, trying to time the market, especially from an index fund perspective, is really a bit of a fool's game. And over the past few months, certainly over the past couple of years, I've seen many people in the comment section, especially going through that bear market last year, saying, guys, I'm going to sell everything, I'm going to pull out and pretty much keep everything in cash or go to gold or what, all these kind of different things. And effectively, if they would have done that, they would have missed out on the current bull market that we're already in, having seen the market rally a huge amount since the start of the year. In fact, I'll have to get this up on screen now as well. I think I've read somewhere that 2023 has actually been the best ever start to the stock market, or whether it was in a certain set of time, but I will pop that up on screen for you now if I can find that one. Pretty extraordinary. Now, where that leaves us for the rest of the year, absolutely no one knows. Whether we're going to just be flat, go down, go up, who knows? And that is the point of this long-term investment game, how we're just going to hold our nerve and keep buying, especially if you're a long-term index fund investor and you want to grow your wealth over the long period of time. Very, very different, of course, if you're trying to retire, draw back an income, or try and predict that market in the shorter term. You've got different problems to worry about. Now, one final point I'll make just before we do jump into the portfolio on the laptop here is that remember, when all these other stocks are booming, these big AI stocks, Nvidia, AMD and the likes, and all these other big tech players, including Tesla, remember, as an index fund investor, you've got this inside your index fund. You have all of these companies here, so you benefit from this wonderful boom that we're seeing at the moment. Now, whether you think it's quite annoying because you'd like to buy at lower prices, either way you'll benefit because you're investing in that market cap weighted index. So as they get bigger, more and more of your money will be allocated to it. And if they reduce in size, again, you might get them for lower prices. And then over a long period of time, you'll get the average price of the market. So again, I guess it was a theme of last month's update and my InvestEngine portfolio update, if you keep track of that one, when I was talking a lot about fear of missing out. Don't fear that fear of missing out as an investor into index funds, into the broad global market, which I think a lot of you, most of my viewers are focused into. You do get and benefit from that. So just hold back and don't worry that you haven't gone 100% into the bottom of the market back in the days when Nvidia, AMD and all these stocks crashed. At the end of the day, you still own all of them. Okay, I'll just get my Vanguard account up now so have a look through my pension and my stocks and shares ISA. Now, a couple of announcements I think you've mentioned, and we did see this from Vanguard. I think we're going to get a couple of things soon this year, hopefully. We're going to get, firstly, two-factor authentication. So I've just logged into my account, and as you know at the moment, all you need is a username and password, which is a little bit lapse, in my opinion, for an investment account. We would like to see some kind of minimum security based on that. And secondly, we are going to see some kind of app, or at least that's what the announcement was on their page just a few weeks ago. So fingers crossed, this will be an interesting one, and I've got no idea what kind of the features we're going to see. If anyone has a beta tester or anything like that, feel free to let me know in the comment section. It will be interesting. I think there's always pros and cons for that. I think the pros of an app are good to have it on a phone to be able to invest potentially and get yourself set up. The downside, potentially, at least from a Vanguard perspective, is if you're a new investor, you probably are going to then check the app more and more, maybe a little bit more than you probably should. I know from my own perspective, especially when you start investing, you're checking that app multiple times a day, every single week, every single month, seeing where your investments are. So it's kind of pros and cons, but it is nice to see them moving towards the 21st century because Vanguard have lagged behind some of the other players like Trading 212, Free Trade, and all the other platforms like InvestEngine with their nice, fancy, shiny apps. Anyway, as you can see, as I was already rambling on, here's how we're doing. Everything is still in the green, which is nice. As you know, we've had a pretty nice rally in the stock market with a little bit of a gentle pullback, bring us back down to reality. Now, rather than draw this out long and say what my pension is and what my ISA is, many of you now will know that I'm in a single mutual fund for both of my investments. So if I have a look overall and go into the investments tab, you can see that I am in a single fund, which is the FTSE Global All Cap Index Fund, the accumulation version. This fund is a complete set and forget, based on market weight, based on that global market. All I had to do is sit back and relax. I can tell you, since moving my investments to this, definitely takes a huge weight off the shoulders. And I honestly don't spend a waking moment thinking about my Vanguard account. As you can see, overall, we're in the green quite nicely. And if we go to the performance tab, just to give ourselves a bit of a flavour of how things have been going month by month and over the long period of time, you can see we're sitting quite nice now at the moment at just over £55,000 in total. We're still a little bit away from the highs. If I just go back, I think my market high was back, that's right, at the end of August here, £56,950. So most of my investments are from my pension. My ISA is relatively small. Well, it could be big for some people. £11,575 actually has a better return than my pension at the moment. Many of you remember that I put my pension in pretty much as one lump sum rather than dollar cost averaging it in from different employers that I've had in the past, as really I just wanted to set and forget for the long term. Now, the downside, of course, of lump summing everything in at once is it's just going to be luck. But over the very, very long term, most of the time, at least the stats say that you should do pretty well. But if you're uncomfortable doing that, remember that you can always dollar cost average in over shorter or longer periods of time. At the end of the day, investing all comes down to your own tolerance and your own risk profile and kind of how you feel about doing your investments. Now, my opinion, at least, as someone who isn't qualified in any way to give you professional financial advice or anything like that, is really just to find your own way. If you prefer dollar cost averaging or you prefer lump summing from lots of money that you've got sat back, just do something with it. The danger will always be have nothing done with it, and you'll lose out to inflation in the very, very long term at least. Just quickly going back to performance across the whole of the account, you can see how much of a good of a start we've had this year. As you can see to the end of last year, how bad things were in December. The account lost just over £2,000 worth of value, but has recovered nicely and been pretty much in the green for the last 4 months. Again, and I mentioned this a lot on the portfolio updates, really the reason I'm sharing this is to kind of just share the normal journey that you have as an investor, and to show how really you kind of want to keep your emotions out of it and not to react to these kinds of moves. Now, I don't doubt at all that many, many people hesitated massively, especially in 2022, and no doubt in 2020, when we had the massive stock market crashes throughout the pandemic, pulled out probably all of their investments and weren't really sure when to get back in. And the more and more you do this, the longer you do this investment game for, you realize you have to detach yourself completely from those investments, especially if you're a long-term investor, when really, if anything, you're going to get a discount on these lower prices if you are still investing. One key thing I always think is useful to remember is that you don't just get one shot in investing, you get multiple shots. Again, if you are a regular investor, getting paid monthly, being able to invest monthly, £50, £100, £200 or more, or anything like that, these are multiple shots at getting different prices in the market, with the overall trend being up. And sure, there's no guarantee with anything investing, but at the end of the day, we are relying on that global market, those companies to come up with some interesting ideas to provide value and hopefully grow in the longer term. Now, while this account remains pretty much static, I do occasionally see the odd comment of lots of people saying, why don't you want to contribute more to your pension, for example, and what are you doing moving forward? Well, currently at the moment, my latest ISA is with InvestEngine, and I'm dollar cost averaging into that one. Make sure you follow those regular updates if you do want to keep track there. My last year's ISA was actually with Trading 212, and before Trading 212 is this ISA sat at the moment. From a pension perspective, you're quite right. I can add in money anytime I want to this pension and get that government top up, get that boost, with the only downside being, of course, that money is locked up until retirement. My priority, in my kind of personal opinion as an investor, is to get that money into a stocks and shares ISA first. I suppose with the caveat being, if you were looking to buy your first house, for example, a lifetime ISA could be a good place to go, because you do get that top up from the government to up to a maximum of £5,000 per year. Of course, you put in 4,000 and the government can put in 1,000, which can go toward buying that first house, or if not, retirement. Now, the good thing about the stocks and shares ISA, as many of you know, is it's very, very flexible. So you can sell at any point. There's no taxes on your dividends or taxes on your capital gains, just in case you needed to use that money for anything. But really, again, what's interesting about investing is it's all up to you. It really depends what you want. If you're very, very lucky enough to max out your ISA, then pension might be the way to go. But that also could be a great time that you might go and seek advice. Just remember, as always, I'm not a professional financial advisor. But anyway, thank you so much for watching. If you do want to get started investing, don't forget to check all the links in the description for free shares and free offers, and it does help support the channel. And I will leave you that video now about the interest rate rises just up here now on the mortgage crisis in the UK. Anyway, thanks so much for watching, and as always, happy investing.